top off your drink, we are about to discuss the silent killer of corporate profits. We are talking about depreciation, or as I call it, the art of watching money evaporate. This concept drives non-accountants crazy. You explain to a sales director that we made a loss this quarter. They scream, "But look at the bank account, we have cash." And you have to stare at them over your rimless glasses and say, "Yes, but the factory is rotting, Gary." Depreciation is annoying because it is a non-cash expense. It is a phantom. You don't write a check for depreciation. No money leaves the building. Yet every year the accountants wave a wand and wipe millions off the profit line, claiming that our assets are tired. It feels like we are punishing the company for owning things. It feels like making up numbers just to make the shareholders cry. We have all been there. You buy a brand new luxury car for $80,000. It is pristine. It smells like Italian leather and success. You feel like a king. Then you drive it off the lot. In the 10 seconds it took you to cross the curb, that car lost $15,000 in value. Did $15,000 cash fly out of your wallet? No. But if you tried to sell it back to the dealer 5 minutes later, they would laugh in your face. Fast forward 5 years. The leather is cracked, there is a mysterious rattle in the engine, and it smells like wet dog. If you claimed your car was still worth $80,000 after 5 years, you would be delusional. Depreciation is just the accounting world forcing you to admit that your shiny toy is slowly turning into a pile of junk. Under IAS 16, depreciation is not actually about valuation. It is about allocation. We are taking the cost of the asset and spreading it over the time it helps us make money. This is the matching principle. Match the expense of the machine to the revenue the machine generates. Here are the 3 levers you can pull to calculate this. Useful life is how long will this thing survive before it explodes. Residual value is what can we sell the scrap metal for at the end. The method. Straight line, the vanilla option, the asset dies a little bit evenly every day. Diminishing balance, the panic option, the asset loses massive value in year 1 and less later. Units of production, the fair option. If the machine works hard, it depreciates hard. If it sits idle, it does not depreciate. Here's the secret. Depreciation is an estimate. When a company tells you their profit is $100 million, check their depreciation policy. If they extended the useful life of their trucks from 5 years to 10 years, they just slashed their annual expense in half and artificially boosted their profit. They did not make more money, they just decided their trucks are immortal. Your takeaway. Depreciation starts when the asset is available for use, even if you are not using it yet, and it stops when you sell it. You cannot stop depreciating just because the asset is idle or because you had a bad year and want to save profits. The rot never sleeps. So pick the straight line method unless you enjoy doing calculus on a Tuesday.